I do think the pandemic has been the catalyst for change. And I say catalyst in the right way to use the word. It's accelerated changes that I could see were going to happen anyway. With fiscal, a change, central banks, higher capex, I think after 4 decades where the forces of secular stagnation have been becoming more powerful, we finally see a change in the secular trends. And let me just make it very practical for the people who watch this who are more interested in market outcomes than they are in economics. The key financial consequence of secular stagnation was the trend decline in interest rates. We have seen for 4 decades the cycle in interest rates in the US. Every cycle low has been lower than the prior low. Every cycle high has been lower than the prior high. So unless, and you weren't doing this, I wasn't doing this, we weren't trading markets in the 70s, unless a listener was watching markets in the 70s, none of us has seen a cycle where the peak in the 10-year Treasury yield was higher than the prior peak. I think that's coming. I think in this cycle, we get the peak surpassing the prior peak, and that's the most concrete outcome of these secular changes. Now, obviously what's happening in Ukraine complicates that, and there are tail risks there that I appreciate. If we can put that to one side, which is in a real world sense almost impossible, but prior to Ukraine, I was absolutely telling people that we would see interest rates in the US go higher than we have seen for several years. It would be the first time that we've seen a cycle peak exceed the prior cycle peak. It's still my base case, but with a little less conviction because of what's happening in Ukraine. As we came out of the GFC, the market was saying, you know what, the long run real Fed fund rate can be 2 to 2.5% positive. And that was what they were also pricing prior to the GFC. So no change. Despite the depth of the downturn, we were going to go back to a world where ultimately the neutral rate of interest was over 2% real, and we would have positive real rates on average through the cycle. It was only when you had the euro crisis and austerity in the US that the near-term rate expectations collapsed and people moved to assuming lower for longer. But even then, they were expecting that we'd go back to real positive rates in the long run. Last 2 years, that real long run Fed expectation has turned negative. So we have markets now that are no longer pricing lower for longer, they're pricing lower forever. We never get out of this. We always have negative real rates. Once again, it's the resilience of the view that nothing has changed. And I just think that's a mistake. I think the world has changed. And that's not to say that we're going to get necessarily higher inflation. It's to say that the interest rate required to have a normal inflation rate is now higher than it was post-GFC. And the peak in rates this cycle is going to be higher than what the market expects. And the world has changed. But the market so far, I've got to say, doesn't agree with me. The resilience of the economy in the face of rising rates is what I debate with everybody at the moment. And what's absolutely central to my view is that the US, and this is particularly true on the US, it's not necessarily true elsewhere, but I think the US will be more resilient than markets recognise. I think the household sector is in as good a shape as it's been for 3 decades. It's delevered. I mean, delevered by defaulting, but hey, that's deleveraging after the GFC. So debt to income is down. It's at around about 100% of income. The debt service burden is at the lowest level since the mid-60s, and most household debt in the US is mortgage debt, and most mortgage debt is fixed rate. So it takes a long time for Fed rate changes to feed into debt service burdens. There's a lot of saving that's been built up through the pandemic because of unspent stimulus. But most importantly, and it comes back to the change in the Fed behaviour and a point I mentioned earlier, which is that wage growth is so strong. Now, for the average American, they don't get dividend checks. They don't get interest checks. I mean, no one gets interest checks at the moment, but yeah, in normal times, the average American doesn't get interest checks. Their bread and butter is wages, is labour costs. Now, in the year to December quarter last year, that was up 3% real. So that means the average American getting 3% more. That's with inflation at 4-decade highs. The nominal increase in aggregate labour income was almost 9%. Now, what I expect is that inflation will fall over the next 12 months. I think that labour income growth will also slow a little, but I think inflation will slow faster. So we're going to end up at the end of this year, I think, with aggregate real labour income running at 3 or 4% real. Now, if that translates into real consumer spending, given that consumer spending is 70% of GDP, that's going to add more to GDP growth than any sensible estimate of what trend GDP is, and interest rates are not going to make a difference. I don't want to come across as a bear at the moment. I mean, I think in my worldview, this is going to be a tough period for low yield, no yield assets. Now that runs the risk gamut from, on the one hand, ostensibly safe assets. I mean, who knew bond yields could go positive? You know, there's going to be people that have been in the market a couple of years ago, gee, this is like a Y2K problem. I didn't know that you could have a plus sign in front of the bond yield. And here I'm going to, I know I'm going to tread on your toes, Raoul, but anyway, to the other end, which is crypto, right? So, yeah, no yield, speculative assets. So, yeah, I think the two edges of the risk spectrum are going to be under pressure, but the stuff in the middle can do okay. I mean, history shows that, you know, your broad-based equity markets, they do okay when the Fed's tightening. I mean, what's a killer for equity markets is recession. And it's not until markets sniff out recession that they suffer. Putin and the pandemic changes everything. And I don't think the markets yet work that out. The market is still in a pre-pandemic mindset where, as I said, when I look at my Bloomberg, there is no debate. The market is saying we remain in a low rate, low growth, lowflation structural situation. And I just think the market is wrong.